In the meantime, stocks are feeling the hopium today. So is it time to go all in this market? Well, let's bring in Stan Kraut, CIO of Aegis Capital, and Rob Morgan, Chief Investment Strategist at Fulcrum Securities. And it almost feels like, and I know it's not the case, but it feels like there are really only two stories out there, guys, at the moment. One is, of course, rising yields, so treasuries, and number two, Apple. So I'm going to put you guys on the spot and just quickly get your thoughts on that. Rob, to what extent are clients asking you about Apple?
Oh, well, Mandy, it's certainly it's our favorite technology name, certainly representative of what we like in a stock. We put it on our list when it was at 400, and even at this level, it's still about 12 times this year's earnings.
So it's still cheap at these levels?
I would say so, absolutely. And I know I'm the 100th guest on this network this week to say that, but I would still be buying the stock here.
Stanley, do you want to be the 100th and first? I can't even say it. Guess to say that it's still cheap at these levels?
Well, if you look at it from a fundamental perspective on the earnings multiple, yeah, sure. But we worry a little bit what it's like in its cycle, and there's been no retail participation in this run-up in the market in general, and in Apple in particular. I can't imagine people sitting at home trading online. What are they going to do? Buy 3 shares at $600? You know, it's prohibitive. So it's really dominated by the professional players and the institutional side at these prices. And the institutional side was really underweighted in Apple, and that's one of the reasons it's had such a big run.
Stan, you know, you're absolutely right. It's not just the lack of retail participation in Apple, it's the lack of retail participation in the market in general. Do you think that they should split the shares, make it more accessible?
Well, you know, that's a mixed thing over history. A lot of people have called for that. I would personally like to see them pay a dividend, and I've been calling for that for a long time. I mean, cash starts to work against Apple. The magnitude of the size of Apple and then hoarding effectively that much cash with a 0% return on cash is really making it sort of hard to keep that growth rate.
Okay, let's go back to the market in general. Rob, I want to talk to you just very quickly about this big spike that we've seen in yields. I mean, obviously the market has been propelled higher partly on the availability of cheap money. If we start to see a sustained rise in yields and that is taken away, is this going to hurt equities?
Well, Mandy, I think what we're seeing here is that the people are fleeing treasuries because they know there's not going to be any more QE. They know there aren't going to be any more bond purchase programs going on, and they're realizing that really the only alternative here is stocks. So many people said, oh, no more QE, that's going to hurt stocks. I think the movement is from treasuries to stocks right now, and once again you know, S&P 500 at about 14 times this year's earnings. Now, we're not going to go straight up from here. My target for the year on the S&P was 1,400. I've raised it to 1,500. But stocks in general, from a fundamental standpoint, are still cheap.
Which stocks in particular are looking cheap to you? If that money is going to come out of treasuries and go into stocks, which ones would you go into right now, Stan? Rob?
Well, as I mentioned, you know, Apple's our favorite technology name, but industrials are our favorite sector. And I'd say, you know, from a global infrastructure play, Caterpillar would certainly be a favorite there. From a machinery standpoint, Danaher, a cyclical sector like industrials with this market, that's our favorite sector.
You're a little different here. You're actually more bearish and cautious on this market at these levels, aren't you, Stanley? What are you seeing that perhaps a lot of other people aren't right now?
Well, for one thing, we look at things differently. We're very high in cash. We have a 50% cash allocation right now. The market's made a run. We look at sentiment shifts. We look at a lot of technical analysis. We look at long-term trends in wave cycles. We look at long-term multi-decade trends, actually, even in what we think is still the beginnings of the deflation of a debt bubble, which is being exacerbated by central bank policies, even more than helping. So, you know, things start to work against themselves. There's a lot of macro issues still out there.
Does this mean you see just a pullback, or are you talking correction territory, Stanley?
Well, I think we're actually going to see a little bit higher high here, but we could be getting very close. You know, Fibonacci relationships, not in just amplitude up and down movements, but there are Fibonacci time relationships. And if you look at it, we had a top in 2000, a top in 07, and if you look at 144 months from the top in 2000, which is a Fibonacci number, and 89 months to the 07 top, guess what this is in March? 55 months. So if we have a third top here and we turn down hard, I, for one, would not be at all surprised.
Rob, do you agree with anything that Stan has just pointed to in terms of any potential reasons why the market could correct?
Well, I certainly think, back to your question to Stanley about are we going to get a correction or maybe a sideways movement. Stocks are overbought here. There's no doubt. They've moved too far, too fast. I think, though, that once again, fundamentally, we've got support here. And I would ask Stanley the question that we talked about earlier with Apple and in the market in general, just no retail participation here. So from a sentiment standpoint, I would argue that sentiment is still terrible, not only for Apple, but the stock market in general. And that could give us some fuel for this rally down the road after we get some type of period of consolidation.
Quick response, Stanley?
Sure. There have been slight rises now, and we're seeing the turn and people coming in more to the equity mutual funds, for instance. And the other thing, a lot of the sentiment indicators are pretty bullish. Look, we've had a very long ratcheting up run. It's like watching a pot boil. Everybody's been waiting and calling for the correction, and it hasn't come yet because everybody's waiting for the correction. So it's a self-fulfilling cycle. And the other thing is, in an election year, everybody thinks, oh, it's an election year, so in some magical, mystical way, the market will be propped up. This might be a different experience this year.
We'll be watching. Stanley and Rob, thank you very much for your thoughts today.
Hey, thanks, Mandy.
You're welcome. Thank you.